Welcome to video 5 in the series, What Does FIRPTA Refunds Do? My name is Richard Kahn, Director and one of the experts here at the firm. This video is comparing FIRPTA withholding to IRS tax. Huge difference. Available in our video section online at FIRPTArefunds.com. Some foreign sellers think FIRPTA is a non-refundable flat 15% tax and do not file for a refund. They have 3 years to do so after a closing or disbursement before the statute of limitations runs out and the IRS can keep their money with their withholding forever. The 15% withholding is big money, as we will see. This is because the FIRPTA withholding is on the whole pie, so to speak, the full sale or disbursement amount. On the other hand, the actual IRS tax is only on the capital gains portion, slice, so to speak. Let's take a look at some examples. Here, example 1 illustrates an exemption from withholding and tax completely. It's a residential property purchased for personal use by a buyer who will occupy it at least 50% of the time each year for the next 2 years after closing. It fits into the $300,000 or below properties and usage range. Example 2 is a residential use buyer occupancy scenario like the last example, but here we see that the sale price is above the $300,000 minimum threshold and below the $1 million maximum. For this exception, that FIRPTA withholding rate would be 10% in that range instead of the normal 15%. So the property cost $400,000, it sold for $700,000, which is within the exception range. Commissions and improvements added $50,000 to the basis, so it's $450,000. The profit is now $250,000. Sold to a buyer who will occupy it full time, so the FIRPTA exception of 10% stands. The 10% on the $700,000 sales price is $70,000. The IRS 30% capital gains tax on the profit, the $250K, is $75,000. Here, the seller owes the IRS an additional $5,000. This is an example why the PATH Act of 2015 raised the overall FIRPTA withholding to 15%, although maintaining the 10% personal use exemption on $300,000 to $1 million buyer using the property residences. Example 3 is the same under $1 million scenario as the previous example, but because it is not a buyer in a residential property that's going to use it, there are no exceptions to the 15% FIRPTA withholding. Because of this, it wouldn't matter if the property or disbursement was $1 million or less than $1 million, it's the 15% withholding. So here, the property cost $800,000, they sold it for $1 million. Commissions and improvements added $100,000 to the basis, so then it make the basis $900,000, the profits $100,000. The FIRPTA withholding on the sale price is $150,000, and the capital gains on the slice of the $100,000 profit is $30,000. So in this case, the seller is due a refund from the IRS of $120,000 minus any costs associated. Example 4 illustrates what a sale of a property over $1 million with no exceptions looks like. It's a 15% FIRPTA withholding. The sale price could be $1 million, $2 million, $10 million, $100 million or more. This is the withholding and tax scenario. So here the example is it cost $1.5 million, they sold it for $2 million. The commissions and improvements are $150,000, which raised the cost basis from $1.5 million to $1.65 million. The profit, therefore, is $350,000. The FIRPTA 15% withholdings on the sale price of $2 million, that's $300,000. The IRS 30% capital gains tax on the slice of profit, $350,000, is $105,000. In this case, the sellers do a refund from the IRS of $195,000 minus any costs associated. Example 5 is a typical foreign investor shareholder case. Here we have a foreign investor shareholder that owns 50% of a U.S. real property holding corporation stock, whose sole asset is, in this case, a $10 million commercial property. Again, the same formula would apply whether the property is $2 million or $10 million or $100 million, all the way to as high as the property sale could go. The property costs $10 million. The foreign sellers are 50% shareholder, so their cost basis is $5 million. It's sold for $15 million. Commissions and improvements were $1.5 million, which therefore adds to the $10 million. So you have an $11.5 million adjusted cost basis. The profit is now $3.5 million. The foreign shareholders' adjusted cost basis is 50% of the $11.5 million, or $5.75 million. The FIRPTA 15% withholding is on 50% of the sale price of $15 million, which is $7.5 million, and 15% of that is $1,125,000. The IRS 30% capital gains tax on the gain portion slice of the investor's 50% is $1.75 million. That's half of the total profit of $3.5 million. And the 30% capital gains tax on that is $525,000. So here, the sellers do a refund from the IRS of $600,000 minus any costs associated. Example 6 is a typical foreign owner developer deal that buys a property, improves it, and sells a shareholder interest at a profit. Here we have the cost of a $2 million property. It was an agricultural piece of land, a lot of land. The foreign seller, when the land became more valuable because of development around it, decided to exchange it for a smaller commercial piece of land of equal value. That qualified as a same real estate for real estate exchange under the 1031 rules, so there was no tax. The foreign owner erected a shopping center which cost $2 million. So the adjusted cost basis is the $2 million cost, the $2 million additional property cost, $4 million. This foreign seller sells 50% interest for $3 million to an investor. So now the total profit is $2 million, because you had 50% equaling $3 million means 100% equals $6 million. Their adjusted cost basis was $4 million. Total profit there is $2 million. So 50% of the owner's profit is $1 million. FIRPTA's 15% withholding on the $3 million, which is the foreign investor purchase, is $450,000. Excuse me. The IRS 30% capital gains tax on the 50% owner's profit slice of $1 million is $300,000. Here the sellers do a refund from the IRS of $150,000 minus any costs associated. In this example, it's a foreign corporation owns a share of a U.S. corporation that owns and operates a U.S. commercial property. The U.S. corporation improves the property, then sells a percentage of ownership in the U.S. corporation to a bigger company that buys in, which is common. This is the FIRPTA withholding and IRS tax effect on the initial foreign corporation shareholder. So originally the property cost $20 million. Then the U.S. corporation owner, the foreign corporation shareholder, owns 50% of the U.S. corporation owner. The U.S. corporation owner sells 50% of the ownership in the U.S. corporation to a high-end national chain for $15 million. This adjusts the basis of the property now to $30 million. So there's a $10 million profit. It presents a $5 million profit, half of that $10 million, to the original foreign corporation owner in a taxable FIRPTA $5 million transaction. So FIRPTA's 15% on the new investing corporation's $15 million is $2.25 million. The IRS's 30% capital gains on the slice of the original foreign corporation shareholding owner, $5 million, is $1.5 million. So here the original foreign corporation shareholder owner of the 50% is due an IRS refund of $750,000 minus any costs associated. We have experience with a myriad of real estate scenarios that can occur, and we are happy to discuss your case in a free consultation. Our website, FIRPTArefunds.com, lists ways to contact us. As you can see, the tax refunds are big money. It doesn't matter if your case is small, medium, large, super jumbo, whether it's residential or commercial. Properly conducted, the tax refunds are big money. FIRPTA Refunds also works to get our clients, big and small, the maximum refunds they are legally entitled to. Thank you for watching. Please get in touch with us when the need arises.